Hello and welcome to Wisconsin Lutheran College's Introduction to Business course. Today we're talking about Chapter 6, the role of accounting in business. So a key term that we have to understand for this chapter is stakeholder. And a stakeholder is anyone who is interested in the activities of a business because the activities of the business affect them. This cannot be confused with stockholder, which is an owner in a business. This here, a stakeholder, is any party interested in a business because it affects them. So a second key term is accounting. And so accounting by definition is the system for measuring and summarizing business activities, taking the financial information and interpreting it so that managers and other decision makers know what decisions need to be made. So let's look at the two fields of accounting. First is what we call management accounting, or some folks refer to it as managerial accounting. And managerial or management accounting provides relevant, accurate, and timely information to people on the inside of an organization so they can make better decisions. If you're the manager of a department and you want to know what sales you have in your department, you receive accounting information so you know what sales have been accumulated over the last period of time. If you're responsible for the inventory or the hourly salary of people and you want to know how much time and effort is being spent in wages, you would get some type of management report that would help you better understand that. So managerial accounting or management accounting is designed to give managers inside the business the tools and information they need so they can make better decisions. In contrast, we have what's called financial accounting. And financial accounting summarizes the past performance of the company so people both inside and outside of the organization can make decisions. And we'll talk about who makes those decisions in a moment, but financial accounting, although people on the inside use the same information, you can look at financial accounting being done mainly for people on the outside. So who uses this information? Well, first of all, again, as we just mentioned, owners and managers look at this information. Are sales where we budgeted? Is my salary at the level that it needs to be? My salary expenses? What is my lighting? What is my heating expenses? All of those things. Some manager who is responsible for that type of thing uses this information to make sure they understand what's happening in their business. Second of is government agencies. By law, any publicly traded company, and we looked at that in the first chapter, a corporation, for example, who is a publicly traded, or the stock is publicly traded, are required by law to submit financial statements to the government to make sure that they're being done properly and that people who are buying and selling stock have the information they need to make those decisions. Third, investors or creditors. So if you were to go to a bank looking to borrow money or to some other type of financing institution, they would take your accounting statements and look at them, analyze them, and determine if it makes sense and is a good risk to provide a loan to you. So investors and creditors look at these financial statements. And lastly, other people look at them. For example, if you were looking for a supplier of a particular service or product, and you would say to them, well, what I'd like to do is buy the product and I'll pay you in 30 days. The supplier needs to know, are you a good credit risk, so that they can extend that that product to you with the assurance that you're going to pay them, in 30 days. So managers inside, as well as government, investors, and other users such as suppliers on the outside. So we have a number of financial statements that we need to understand. The first and foremost is what's called an income statement. What the income statement does is it tells us what my expenses and what my sales are, so I can determine if I make a profit and how much profit is being made. So here's 5 things that are on the income statement. First of all, revenue or sales. Secondly, how much did it cost me to make that product or service? Secondly, what is the gross profit? That is revenue minus cost of goods sold gives me a gross profit. What are my operating expenses? Those are all my other expenses, not counting the cost to make the the product. And then lastly, that gives me my net income, or hopefully not, but it might show a loss. And so revenue minus the cost of goods sold is gross profit. Gross profit minus operating expenses is my net income. So here is a very simple income statement. I sold 100 units. They were $10 each. And so what I have is $1,000 right here of sales or revenue. It cost me $6 a piece to manufacture those 100 units. So my cost of goods sold was $600, giving me a gross profit of $400. I had salaries for my operating expenses, $40 worth of advertising, a table rental of $20, and so I had operating expenses of $300 and a net income or a net profit of $100. If I look back to the cost of goods sold as $5 a unit, so I've changed this number here, we can see that my sales stays the same, my cost of goods stays the same, but now I have a gross profit of $500. Salaries, advertising, and table rental do not change. Those are what we call fixed costs because they don't change based on the number of units I sell. And so my net income or my net profit now has risen to $200. The same is true as if I increase the number of units I sell. So now I have 150 units times $10 is $1,500. My cost of goods sold goes up because every unit I sell costs me $6 to make. And so now my cost of goods sold goes to $600 or $900, leaving me a gross profit of $600. Salaries, advertising, and table rental again does not change, and therefore my net income or profit has increased to $300. I'd like to just show you what would happen if potentially certain costs rose without sales rising. So here we have the 150 units times 10 or $1,500. If my cost of goods sold goes up to $7, then my cost of goods sold for the whole month is $1,050, leaving me a gross profit of $350. But if my salaries or advertising or table rental goes up, what's known as operating expenses, I then have a loss of $50, and that's normally shown as a net income in parentheses of minus $50. One thing I'd like you to be aware of from an income statement, it is for a period of time. In this case, it says for the month ended September 30th. So what we're saying here is for the entire month, we had $1,500 worth of sales for the month of September. So it could be for a week ended or a year ended, but nonetheless, what we're saying is over a period of time, my sales and cost of goods sold and eventually profit was over a period of time, and you can always tell that by the heading on the top of your income statement. So a second key term is break-even analysis, and this is a way to determine how many sales I need to make to break even. And so to break even, I have to know exactly all my expenses, and as I alluded to a little earlier, we have what's called fixed costs. Those are costs that I'm required to pay regardless of how many units I sell. Variable costs go up with the more units I sell, go down with selling fewer units. The difference between what I sell and my variable cost is what's called the contribution margin per unit. And then lastly, when I look at how many units I need to sell to break even, it's called a break-even point in units. So how many items do I need to sell in order to break even? So here's an example I put together. If DRK Enterprises is looking to teach a seminar, DRK rents a room for $200. That's a fixed cost. Regardless of how many students come to my seminar, I need to pay that $200. That $200 will not go away. Each student participating receives a book and supplies, which cost $50. Those are variable costs because the more students I have, the more supplies I'm going to have. And the price to attend the seminar is $100. So the question is, how many students does it take to break even? So the contribution from each student is $50. You determine that by $100 for the student paying to come to the class minus my variable cost gives me a contribution of $50. The fixed cost, as I alluded to, was the room rental, which was $200. So if I take my fixed costs divided by my contribution, tells me that I need 4 students to come to my seminar to break even. And break even means I don't lose any money, but I don't make any money. Here's how that looks. So if 4 students, therefore sales would be $400. Expenses are $200 fixed and $200 variable. Again, variable would be $50 times 4 students, and so I break even. If 3 students attend, now sales are $300. Fixed expenses don't change. Variable expenses go down, but I lose $50. 300 minus 200 minus 150 provides a $50 loss. Same token, if 5 students sign up, now sales are $500. Fixed expenses, again, do not change. Variable expenses go up because more students. However, 500 minus 200 minus 250 gives me a profit of $50. That concludes the first section in Chapter 6. I look forward to sharing more information with you in subsequent videos.